Okay, so what I want to talk today is, of course, about the FOMC that we had this morning, right? Today for me, 6 a.m. If we look at the economic calendar, let me grab it. For me, it was like 5. This is not my time. For me, it was 6 in the morning. Sorry, not 5. 6 in the morning. Yeah. So 6 in the morning, we had FOMC. We had the FOMC statement that we're going to read together. We had the interest rate decision, and most importantly, we had the press conference. Okay. So if we go to the Federal Reserve monetary policy, we have it here already. I'm going to send this link to you guys. So it's going to be on the chat. So we already have it here 30 to 31st, just depending where you are. It could be 30. For me, it was first. But anyway, so if we click on the statement on PDF or HTML, I'm just going to click on PDF, and then it's going to open a new tab. We're going to read through these in a second. But I do recommend you guys always read the the monetary policy reports every time it goes out to the public. Okay, so every time we have a interest rate decision, we're going to have the monetary policy, the statement, and every time after we have the monetary policy committee from the FOMC, Federal Open Market Committee, we're going to have the minutes. Minutes are very important as well. Okay, so minutes are basically word by word what was talked on the day. Just drag it here. So you guys can see my screen. Yeah, you guys can see my screen. Okay. So click on PDF if you're on the computer. That's great. And I'm going to wait for you guys. All right. Here we go. So let me grab my pen first. Okay. All right, so let's just start. Recent indicators suggest that economic activity has been expanding at a solid pace. Job gains have moderated since early last year, but remain strong. And the unemployment rate has remained low. Inflation has eased over the past year, but remains elevated. Okay, so pause here. All right. Inflation has eased. So what does that mean? Basically means that inflation had come down a few points over the past year, right? Last year, we did had the year starting at 6%, and we finished the year on like 3.2%. So indeed, we had a 3% drop on inflation year over year. Okay, so that's good. That's positive. But they do acknowledge it that it still remains elevated. So what does that mean is they know that inflation has come down, but they know that it's still over the target range. Okay, it's called a target range. I'm getting really good on writing with my moles. Wow, pretty impressive, to be honest. Look at that. All right. So it's called the target range, and every central bank has your own target range. But most typically, they are between 0 to 3%, 0 to 2%. Okay, 0 to 2%. All right. For the Fed, especially, if I'm not wrong, is 1 to 2%. Okay, 1 to 2% for the Fed. And this moment we are at a 3.2%, if I'm not wrong, year over year. Okay. Now, the Committee 6 to achieve maximum employment and inflation at the rate of 2% over the long run. The committee judged that the risks to achieving its employment and inflation goals are moving into better balance. The economic outlook is uncertain, and the committee remains highly attentive to inflation risks. Okay, that's a good thing. In support of its goals, so basically these are all the goals that they are trying to achieve. They're going to explain to us on here that in support of these goals, the committee decided to maintain the target range of federal funds rates at 4.25 to 4.5%. All right. Four quarter and 4.5%. In consideration, any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risk. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. In addition, the committee will continue to reduce its holding of Treasury securities and agency debt and agency mortgage-backed securities, as described in its previously announced plans. The committee is strongly committed to return inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. Okay, pause here. This one. So what does that basically mean? Well, this basically means that not that they are, how can I say that? Not that they will raise, okay? But if everything that they're expecting goes against on what they're expecting, then they will raise another, whatever, 25, 50 base points, how much they think that it's going to be good on that moment. So let's take just in consideration here, right? The committee would be prepared to adjust the stance of monetary policy to appropriate if risks emerge that could impede the attainment of the committee's goals. What are the goals? The goals are here. Bringing inflation to 2%. Okay. Let me grab another pen. So the goals, these are the goals, okay? Okay, so these are the goals. And if they can't get into the goals, what they will do is they will raise, actually not raise, hike. Okay, so they will hike another however percent. They think that these may be appropriate. So if you want to take a screenshot from here, just take a screenshot. I'm going to move forward in 3, 2, 1. Go. Cool. Now moving down. Into account a wide range of information. The committee's assessment will take into account a wide range of information. Okay, so here are what we have to look for the next FOMC, including readings on labor market conditions, inflation pressured and inflation expectations, financial and international developments. Okay, so here are the things that they are looking. So this is what, Fed is looking. Okay, so here's what the Fed is looking. So basically what they're looking, labor market conditions. inflation pressures and inflation expectations, and financial international developments. From those four or five, in my opinion, the most important would be the inflation pressures and inflation expectations. Okay, these are the most important for me at the moment. Okay, so this one here. Why? Because this is what moving the market pretty much. CPI, inflation, and so on. So this is what it's moving the market in the last year, as well as the central banks. Okay, so moving down. What they do? So the decisions regarding monetary policy implementation. So, oops, sorry. So the governor of the Federal Reserve, yeah, they will maintain 4.5%. As part of its policy decision, the Federal Open Market Committee voted to direct the open market desk at the Federal Funds of New York and to instruct it otherwise. So they will do open market operations as necessary to maintain the federal funds, conduct standing overnight purchases operations with a minimum bid of 5.5% and with an aggregate of 500 billion. So they haven't changed it yet. So they're still buying 500 billion of Treasury securities. 160 billion per day. Rollover at auction. Okay, so there's not much here. So they're just basically buying mortgage-backed securities. They're buying those treasury bonds and they're reinvesting it in mortgage-backed securities. So not much to hear. All right, so these are my take. Okay, looking at here, nothing too special, because it's very similar from the last one in December. So if you look in 2023, we had the last one here in December. If we put side by side, okay, so this one is the one for December, and this one is for January 1st. So we didn't have anything, right? So just a few things here that changes. So recent, because they had anyway, so let's read it. Recent indicators suggest that the growth of economic activity has slowed from its stronger pace in its third quarter. Recent indicators suggest that economic activity has been expanding at a solid pace. Why is that? Because the quarter four release of last year was stronger than expected. Okay, so they had to change it from here, and they did grow over 3% in the last year GDP. Okay, so that was quite good, to be honest. Job gains have moderated since early in the year, but remain strong. Job have moderated since earlier, but maintained, and the unemployment rate has remained low. Inflation eased, yeah, pretty much the same. See, that's a good question. We can have a look at the dot plot. Let me grab it here. See, oh, this one. I don't think it will change from last year. Yeah, it didn't change anything. Yeah, 2023, 5.5. Right now, they're expecting to be at 4.5. Let's call it 4.5. So that's pretty interesting, because I'm expecting them to be like somewhere around here in 2024 and not here. That's something interesting. Anyways, so this is pretty much it from the statement. Okay, so nothing too new, nothing to worry about. Do you guys have any questions regarding this that I can quickly answer? Please put down in the comments. No? Zero? Nothing? Sure. All right, moving ahead. No one had questions. Okay, I'm going to close this, close this. What is the change in US yield? What is the change in the US yield after FOMC minutes release? You want to see the chart, you mean? we can just come here and see the US 10-year yields. It dropped. The 2-year yields, it just stays normal. Okay. All right. Now, a few other important things I want to mention about it. If we look at the dollar, it didn't have strong strength, right, to push, and it just pushed because of the hawkish instance, and not the hawkish. Okay. All right. So taking this sense. So we had, and I was telling this as well. Okay. I was a big believer, let's call it like this, that the Fed would cut. Sorry. That the Fed would cut 25 basis points in the first half of this year in March. Okay. Even though if we look now, it's completely different. Okay. So let's go. So March. So the next one would be in 20th of March. We're not going to have in February. We're only going to have in March. And then we're not going to have in April. We're just going to have in May. Sorry, January, February. Okay, anyways. So March. All right. So it was 60% here. So there was a time that people were believing, even I, they would cut in March. Well, now we had Powell coming in, all right, to the market, to the speech, and actually telling us, like, we're not going to cut in March. Most probably we're going to go in the half of this year. So what the market have been now, they have more to another pause in March. And if we look to May, now 60%, so basically the other 30% that were believing, another 23% that were believing that the Fed would cut in March, sorry, they moved away to May, and they're here. All right. So 60% right now of the market are predicting it. They are believing that they will have a cut on May, and another cut on June. Okay, another cut on June. So we're going to have 125 basis point on May. That's going to bring to 5.25, and then we have another one that is going to bring to 5%. Okay, and then July, we're going to have another one. So that's going to be 50, 75. There's another one here. And is it another one? 425? Yeah, there's another one here as well. And there's another one here as well. So the market is predicting one cut by the meeting. So for me, that's a little bit crazy. I don't think they will start to cut in this pace. Okay, I don't think it's. I don't think they will like cut in every meeting after March. So May, June, July, September, November, and December. I don't think they will cut through all of them. But if we sum, so that's going to be 50, 100, 150 base points of cut. A few institutions were talking about 150. I didn't believe it. Now I'm a little bit shocked right now. Okay. So if that actually happens, that's going to be pretty bad for the US dollar. Okay. Pretty bad for the US dollar. So just pay attention on March meeting, and then we see how we're going to go for May. Okay, we're going to have collecting a little bit of data there. Now, so coming back to the US dollar index, so it did have a push. Why? Because now investors were predicting. Where's my pen? Investors were predicting. So they were predicting. All right. So we have 1, 2, 3, 4, 5, 6, whatever. So they were predicting a cut on here, right? So therefore they knew it. So we are on this one, all right? So this one didn't cut. So this one, no cut, all right? This one, no cut. This one, they would have a cut, okay? Only on this one, they were predicting a cut. Well, now what happened is that they won't cut on here and they will cut on here. Okay, so they moved these 25 basis points to a pause and they moved to another meeting. So that basically tells us that investors will keep buying US dollar until somewhere here, all right, in the middle of those two. Okay. And then here they may start to dumping those bonds, treasury securities, and so forth, because they don't want to be holding something that will depreciate month by month. Okay. And then another 25, another 25, another 25, another 25. I still think that is too much, but we have to see how this gonna occur. We have a question here from Patrick. How do we track US Treasury yields real time? It will offer a hint how US dollar will move in the next few months. Well, I think someone asked me this question last week, but tracking the US Treasury yields in real time, it is crucial, to be honest, for understanding the market sentiment and the potential of a currency movement. Especially for the US dollar in this scenario that you mentioned. I know a few common methods to monitor US Treasury yields that I can give it to you, but I don't use much them, right? So, like Bloomberg, CNBC, Reuters, Financial Times, they all provide real-time financial news and market data, including updates on the treasury yields. Government websites as well, like the website of the U.S. Department of the Treasury. If I'm not wrong, is treasury.gov. Let me search it here for you. Treasury.gov. Okay, here we are. Oh, yeah, the daily treasury par curve CMT, right? Yeah, so here it is. You can track it here every day. Like you can, it's not going to be minute by minute, but you can track it here every day. And then of course you have financial data platforms like investing.com, Yahoo Finance, TradingView. That is the one I use. So I just go here, US 10-year yields. And this is where I track. So if you want to use TradingView, it's much easier, simpler, free. You don't have to come day by day. It's updated minute by minute. Okay, so how you do that is you go to TradingView, you write US 10, and then here, and then you have it, or US 2, or whatever, which one you want to follow. You have the 30 as well, and so on. But the most two I follow from US, Japan, Europe, and Australia. So they're all here. Someone said financial juice. I've never heard about financial juice. Let me see. Yes, I've heard about it. I've heard about it. Yeah. Okay. Not I heard it. I've seen it. Yeah, if it works, that's good. You can track in there as well. Yeah. 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 So this is pretty much it from my end in the FOMC. Okay. Do you guys have any questions regarding? Because it was pretty expected, as I've mentioned. I've been mentioned last week, the whole week, right? Like another pause, a little bit hawkish to a neutral tone. But the only thing that I wasn't expecting was the Powell addressing how he's not going to cut in March and that he need more data towards half of the year to actually be able um, to cut the rates. Let's see if there is any opportunity going on here. Let's have a look. Okay, JPY, USD JPY. What are the trades you guys are in? Today's going to be very chill, boys. I'm pretty tired. Previously, you mentioned that the ECB is waiting for Fed to cut rate before it do so. Yes, market is expecting ECB to cut rate in the Emperor. Have you or opinion changes so far? No, I haven't. So right now, what they will do is they will come in. We have them today, don't we? Yeah, we have them today. I know we have CPI for today. We have boy. Okay, we have the Bank of England. Yeah, we're not gonna have them this week. We're gonna have them next week, isn't it? Anyways, yes, I do. I do believe that they will still wait for the Fed um, to cut first. Uh, yes, there is the yen. It's pretty strong right now, and I looked at the pound yen this morning, and I was pretty happy for you. So that's pretty good. Um, let's see how retail traders are. UPJPY. Yeah, see, yen is the strongest one right now. See, yen is very, very strong. When we see the exam, we still have most of retail short, but it's just because we had this large uptrend. Okay, so all of them are stuck on those positions, so they're not gonna like be short on the top of it. All right, this is what they do. So in my scenario, yeah. Now, the reason why the yen is going up, it's if we look at the yeah, man, save lives. The reason why the yen is pretty strong is because since last Tuesday, actually, like beginning of this year already, we had a up move of more than 0.10%, if I'm not wrong. Let me check. 24. Yeah, 10% already up on the Japanese 10 years yield. Okay, so when we look to these, most of the as I've mentioned last week or last Tuesday, right? Most of the investors are buying Japanese yen right now. Sorry, not Japanese yen. Sorry, they are buying Japan 10 years government bonds, and of course, this does have a impact on the Japanese yen. So therefore, they are actually making the Japanese yen stronger. Okay, and this is occasionating the whole short positions that is going on the on those pairs that you've mentioned, especially pound and euro that are very weak at the moment. But New Zealand and Aussie, I'm not sure why they're going down much. But pound yen and euro yen, yes, that's a pretty good idea there. Um, CHF JPY, yeah, pretty much sideways. One of my mates, he got a short position just here on Aussie yen. He got a short position here. 25 lots, just dumping there. 40 grand, not bad. Anyways, so I guess, all right, I guess gold. Yeah, let's have a look on gold. Yeah, I got it. I got gold wrong. Okay, I got gold wrong. At the beginning of the webinar, I was looking at gold and got it wrong. I thought it would be coming down, okay, same as the petroleum, the WTI, but instead they're going up. It just shows me how investors are actually seeking safe havens. It intrigues me a little bit because we had gold in a downtrend, right? Since when it hits historically highs here, and now it's just picking up small steps again. Okay, and it just, if it breaks this stop, maybe possibly can go even higher. So I'm just going to watch out for gold. I'm going to step back a little bit, step aside a little bit, and just watch what this is going to be doing. Is there a website we can trace how much the investors are putting the money on Japanese bonds, the changing percentage over the weeks? Yes, you can. It's called IMF, but it's a little bit complicated to use. But yeah, there is one. Is the IMF. Is it this one? Yeah. Or you can use MOF as well, Ministry of Finance. Just wait a little bit because it's a lot of data. I think I'm gonna have to log in. It's free, but the problem that it's free, it's you can pay as well, but the free version, it's like it take ages for updating the actual data. Okay, I don't know how much they charge for the paid version, but yeah, you can use the imf.org. They're pretty good. They have, I think, 7 days, if I'm not wrong, 7 days of data, and you can track as well. Um, oh, you want only bonds? Yeah, the bonds, I guess, would be only IMF. I don't think the CFTC would help you with that. CFTC maybe. Um, we can have a look. Metals and orders. Okay, give me the long format here pretty quick. I'm just going to search for you guys. Just a second. Bonds. Tray. Yeah, they don't have it. But if I search here, okay, yeah. Oh, okay. Euro short-term rate. Okay, yeah, we can have Japanese yen. Yeah, no, they don't. They don't. Yeah, only IMF. Yeah, there you have it. Yeah, you can use IMF. They're pretty good, man. They're pretty good. Pretty good. They're the one that always give me those data. You can just create an account. It's free, no charges. And but remember, it's heavy data, right? So it's going to be pretty, like, you have the data tables and everything. You can search about it. But yeah, pretty heavy. If you need any help, just let me know. Right. Thanks. I will take a look at the website. Yeah, take a look at them, man. If you need any help, just let me know. Yeah, so just finishing go. I guess I would be a little bit stepping back and just watch what it will do. It feels like I'm out of control of, my mind, what it can possibly happen here. Because I thought this would be the pullback. Yeah, maybe we can be having a little bit higher pullback. If we put a FIBO here, we have, yeah, we have hold on the 61. Now we probably went to the 80. Yeah, I'm just gonna watch what's gonna happen. And yeah, just look at it. Now, I want to bring attention to one thing here that I was looking at my desk this morning. Have you guys seen how much Nasdaq went up last year? Yeah, I probably yeah, I do think it will come strongly tomorrow. Yeah, let's have a look at Nasdaq. Oopsie, sorry. Okay, look at these. Okay, so 2023 here. If we get a ruler since 2023, since the opening of 2023, or the end to the closing of 2023, we had here a staggering 50%, 50, 50% doing nothing, just buying as and Nasdaq. Like what? How did I thought about this? Like why? What I was doing? Look at S&P 500. 23%. Get 50 plus 20, it's 73%. All right. Doing nothing. This is just incredible. Like equities were pumping, indices were pumping last year. I don't know how this year will be, but that was really good, really, really good, incredible. It got my eyes this morning. I was like, wow. Anyways, so let's have a look for tomorrow's NFP. Um, where is it? Oh, it's gonna be Saturday for me. Okay. Oh, we still having core CPI today for Europe. Okay. Sorry, we have CPI, core CPI, and CPI. Expecting to decrease. Yes, that's correct. That's correct. This is why I didn't bother um, to trade stocks and equities and indices last year because I was like, yeah, currencies will be better. I'm just gonna keep longing currencies and shorting the other ones that are not raising interest rates or they are having a rate differential between countries. And it did work out. Like I think I've closed like 58% last year, but still I could make 100%. Textbook needs to revise to factor in recent. You know, when you go to uni and the teacher is like, listen, bonds don't go down. Bonds don't go down. You don't sell bonds. You only buy bonds. Well, last year bonds did go down. It did work. They a lot. They did drop a lot. So tell me how how this happening now. So yes, we do have this discussion on the trading floor quite often, to be honest. Um, anyways, so we have a CPI here for today for Europe, and then we're gonna have tomorrow um, the NFP. Just let me find where is this. We're not gonna have NFP this Friday. Oh, here, NFP 173. Oof, boy. Mm. So that's the thing, right? Usually, I've done a spreadsheet last long time ago Um, okay, where's the AGP? It's Thursday. Well, but where is this now? Where's the ADP? We had ADP today, didn't we? GDP, crude oil. Okay, here. So usually when the ADP comes lower, it's an inverse in the inverse scenario. Usually when the EDP comes lower, the NFP comes higher. When the ADP comes higher, the NFP comes lower. So I've done a spreadsheet on that. I can try to send to you guys tomorrow when I get to the office, but I'm pretty sure that this is still working. Okay, but you looking at a global scenario, like macroeconomic scenario, most probably we will get some numbers a little bit higher than expected, like a little bit higher, not nothing crazy. Um, but that's the problem. Like next month, we're gonna have, we're gonna be revising down. It's not gonna be that effective. So January is always like a boom, because we had people getting employed because of Christmas, because of New Year's, and people searching for jobs, and this and that. Economy was growing fast last year, so most probably yes, we will have a little spike up on the NFP. All right, so this is why I'm still holding my pound dollar position. Okay, so and I'm gonna still keep holding this because now I'm predicting a drop into somewhere around to 1.2%. Yeah, so somewhere around 125.5. Okay, so this is where I'm looking to get soon. Not necessary. So I did try to correlation in the past, but sometimes it does not correlate well. We can have very good ADP non-farm employment data, and we get very good FP and vice versa. Can you show where I can get a re-entry? I have given up doing correlation. Yeah, correlation is good, but like that's the problem with correlation. They work for some time and then they won't work for another time and then they work from some time. This is why I stopped doing it as well. Because it was like a project, like what correlates with what, but I just didn't I didn't want to have it's too much headache. Can you show where I can get a re-entry? Look, yeah, that's exactly what I say. Yeah, they keep revising it at a later date. Yeah, exactly. It's always BS. Okay. Re-entry on pound dollar. I can't give you where exactly you're gonna re-enter, but you can use your techniques, all right, to interpret the market structure and get a bounce back on on the market. So if the guys from here that wants to help Casey, because I unfortunately can't give an entry point. It's just I can't give it like, okay, this would be a good entry point. But yeah, look, maybe if we come back to those areas here again, that I think a bit hard to days happens, that would be a good area. But it's already coming down. So euro dollar always go faster than pound dollar, but they tend to walk on the same direction. Okay. So in my perspective, I'm looking to just maintain my position here and don't move it. Yeah. Um, yeah, that's pretty much it from my side. Do you guys have any question? What I do is I take note of how many good data for this week, how many for next week, which one is more critical, like CPI retail sales, and form a judgment from where USD will go from current week to the next, and from my trend bias to trade a US dollar currency pair. Yeah, that's pretty much what I do as well. Very similar. What I do is I get a spreadsheet and I do like, okay, so this is a strong, it's two. So this is not strong, 1. This is bad. This is neutral, 0. This is bad, -1. This is very bad, -2. So I just do a little scoring system backed by technical analysis, support and resistance level, and Fibonacci. Yeah, I don't use much Fibonacci, but yeah, it works. Duncan does use a lot of Fibonacci. Okay, guys, so we're gonna end now because very easy going one today. Hopefully, I could give some knowledge to you guys, and yeah, if you have any questions, just please let me know on my Telegram. All right, guys, have a good night, and I see you in the next week.